Hey everyone, thank you so much, Cindy and Sandeep. That was incredible. Actually, the questions that you submitted, 30 to 40% of them were actually in that module. So you were a part of that. And I'm just so blessed that Cindy was able to share some really amazing gems there. And Sandeep was an amazing moderator. So thank you. We're here really to pull back the curtain and peel the onion about angel investing. And so we started it out a little bit, very high level, thinking about it on a macro level. So now let's get a little bit more into the technicals. So just once again, cheat sheet, this is the time, the money slide for you to screenshot this if you like. But the valuation is essentially the value of a business, kind of taking into account the market forces of the industry and sector in which that business belongs. We're going to talk in depth about this, and it's never really an exact science. It's more of an art and a science. Pre-money valuation, that is essentially the agreed upon value of the company before the new money and capital is invested. So and post-money is the pre-money valuation plus the latest funding round. So here's an example. If there's a company that's currently valued at $3 million, that's the pre-money. And then if Erica, for example, is invests $1 million, then the post-money valuation is $4 million. And that means that Erica, with her new investment, owns about 25% of the company. Very simplistic, but just wanted to give you a little bit of an example there. Lead investor. So essentially, there are the ones who, set the price and the terms of the investment round, and everyone else, who adds money into that round is considered a co-investor. And last but not least, dilution is essentially saying it's a process of startup stakeholders gradually losing their percentage of ownership of the company with each funding round because they're continuing to, new folks are continuing to add on, and they're just getting a smaller slice of a bigger pie. So, hey, Erica, how are you doing today?
Hi, I'm doing great.
Amazing. So if you guys, I've had the amazing honor of learning, of knowing Erica for a long time now, but Erica, if you could just briefly introduce yourself and also just share a little bit about how you became an angel.
Yeah, sure. Well, hi everyone. It's so nice to see you guys here. It's amazing. We've got, around 500 people that are learning from us today. So it's great to see a lot of people who are interested in angel investing and interested in becoming better investors and founders who are maybe interested in learning more about how we look at the process. So my background is, first of all, I am the founder of 1,000 Angels, which is a digital platform that helps connect accredited investors with companies raising seed and Series A. I'm also a founder and partner at Rain Ventures, which is a seed and Series A stage venture fund. We mainly invest in tech and tech-enabled businesses, but I've actually spent my entire career in finance. Started off my career on Wall Street in 1998, doing traditional investment banking, corporate finance, so public market assets, IPOs, debt issuances, et cetera. Did that for quite a few years in roles both as a banker, asset management, and as a fixed income trader. So a lot of experience with several different asset classes. Did my MBA here in New York City at Columbia Business School in finance. And in 2006, I was really fortunate to have the opportunity to shift out of the public market assets into early stage investing. So I've actually been doing seed and Series A stage investing for a little bit over 14 years now. And during that time have had the opportunity to work with thousands of amazing companies in a variety of different roles, both as an investor and as an entrepreneur, and of course to invest in hundreds of really exciting early companies. I'm also an adjunct at Columbia Business School through their executive MBA program, where I teach a course on venture investing, and really love digging in with both founders and investors on the basics of capital strategy and how to understand capital strategy in order to make really good investments. So we'll cover a little bit of it today. I'd say the topic of startup valuations could be an entire course at Columbia. So we'll just cover it in like 15 minutes though, right? So that's a little bit about me.
Fantastic. Thank you so much, Erica, for that. So, and just to go into your angel investing experience, can you talk a little bit about that, you know, your record and also the way you've done with that, and also how COVID has really affected your angel investing experience?
Yeah, sure. So, you know, my experience is a little bit different. And I think every early stage investor has a different way that they kind of got into this game. You know, as I mentioned, this has always been my career. So my career, you know, for the last 22 years has been finance. For about 14 years of it, I've been focusing on this particular stage. So I got my start actually as executive director of what's now one of the largest angel networks in the world, a group called Golden Seeds. And they were actually one of the very first organizations to focus on the sort of value arbitrage that's there in investing in female founders. So that was like a long time ago. People actually thought the whole idea of like investing in female founders was crazy. They're like, I don't even think there are female founders. And so, you know, we're really lucky. The founder of that company, an amazing woman named Stephanie Henbury-Brown, who had been the COO of fixed income trading at JP Morgan, actually was one of the first people to really put a lot of effort behind mobilizing investors to start focusing on, you know, the alpha that's often generated by making investments in women-led companies. So I did that for a few years. And although I don't exclusively focus on female founders anymore, you know, decided to stay within that sort of seed through Series A stage of investment, and have, you know, run accelerators, you know, obviously started my own companies, started a fund, started a digital platform for this type of investing. So I've been doing it for a long time through a variety of different vehicles. But I think what really, you know, made me find my home in this place is that one of the things that I love about very early stage investing is that it's very much about personal connections, about relationships, about being able to identify founders who have that je ne sais quoi that you need to be able to build, you know, a business that's worth several hundreds of millions of dollars, that, you know, is able to attract an amazing team, and able to hopefully get you to a successful financial outcome.
That's fantastic. And I love the fact that you started out also with Golden Seeds. They're great. And, you know, supporting women founders and just, you know, founders that are underestimated and underrepresented, I think is a wonderful, you know, thesis to have. So here at Republic, you know, 40% of our founders are women, 20% are Black and Latino, and we're just, and they actually hail from about 28 different states. So super proud to also, you know, be part of that movement. So one last question before going to evaluation deep dive is, what should angels, and by the way, 70% of people here have invested before. So what should angels, you know, really look for in an angel group?
Yeah, you know, I think that, it's really case by case because, you know, they're all organized so differently. So, you know, for example, an organization like Golden Seeds was really sort of founded with a specific thesis of investing in female-led founders. So, you know, that's something, if that's attractive to you, you know, that could be great. Maybe you want to sort of develop a more personal network of people who are interested in the same thing. If you look at an organization like New York Angels, and I'm just going to sort of talk about some of the ones around here, but, you know, there are obviously angel groups all over the country. They were really sort of started with a focus on investing in tech and media because that's where, you know, those were sort of interesting industries that the founders of that group had core competency in. You see affinity groups like Harvard Business School Angels, right? So if you want to maybe be in one that, you know, is alumni related. So there are really theses around sort of sector focus, around geographic focus, around affinity groups. And so it's really whatever is right for you. You know, for example, the organization that I run, 1,000 Angels, is really less about sort of affinity and making friends and sort of a little bit more about a very bespoke client experience. So if you want a lot more hand-holding with your investments, you know, that would be right for you. So there are a variety of different ways to get started, but I would say that I highly recommend that whoever is interested in getting started as an early stage investor does it with some sort of like training wheels and guardrails up, and a group or an organization or a platform can provide you that. You know, sometimes people sort of think that, you know, they should just go start wandering the streets and see who pitches them for money. And that's a very dangerous way to get started investing. So, you know, one of the things that I think it's so important to be cognizant of, and why I do a ton of education. I mean, I do webinars constantly, you know, on my own webinars, and for other people, I'm probably doing at least 2 educational things per week, is that because this is such a long duration asset, most of these investments will be outstanding somewhere between 7 and 10 years. It takes a really long time to actually be experienced as an investor in this asset class. So, you know, for most people, you know, you have to be doing it for at least like 10 years to even kind of have a sense of really what's going on based on real life experience. So, you know, find an asset class that, you know, resonates with you, find a thesis that resonates with you, find, you know, the style of interaction that resonates with you, and you know, get started slowly, but with help.
Fantastic. And you're right, this is a high risk, high reward industry. And so definitely it's great to be surrounded by amazing folks that are experienced and can, you know, lend a hand on that side. So Erica is one of our teachers that will actually have a presentation here. I love those types of teachers too. So without further ado, Erica will present some of the slides that she has graciously shared with us, that she also uses on her 4,000 Angels as well.
Yeah, great. So, you know, I think that the concept of valuations is one that doesn't really involve, you know, a ton of really technical math, but it's something that, you know, people tend to skip over a little bit when they're first getting started, like really sort of understanding how to evaluate early stage companies. And the reason I think it's so important to take the time to look at this is because companies sort of at the early stage, and I would say that that's, you know, from friends and family through probably about, you know, Series C, Series D, sort of growth equity stage, are valued completely differently, right? It's like, you know, they kind of have to be analyzed, you know, like they're in a different universe. So if you're somebody who actively invests in the stock market, you're looking at PE ratios, you're looking at price to book, you're looking at earnings growth. You know, unfortunately, we don't have any of that stuff. So we have to kind of make our own benchmarks and metrics in order to determine what is an appropriate value. And sometimes it doesn't even seem to make sense, right? So we'll be going through some of the specifics of that very briefly today. But most importantly, you know, we want to probably think about how are we going to expect the current market conditions to affect early stage valuations, right? So what are some of the things that we need to be even more careful of as we're entering a crisis to be able to properly evaluate valuations and remain competitive? You know, some people kind of think, oh, COVID means, you know, everything's a fire sale, you know, is that necessarily a smart way to look at it, or is it not? So by understanding some of the basics of valuation and understanding that they don't move in the same way that you would expect public equity market securities to move, we can get a better sense of how we can participate in the capital markets in a really smart and intelligent way to generate returns. So you can go to the next slide. So this slide, and I don't know, Cheryl, are you going to be like sending around the slides after, or?
We will have the recording available.
Okay, so for people who have the recording, you can press pause because there's a lot on here. This is sort of a little chart that I put together to give folks kind of an idea of like general valuation guidelines. And one of the most important things to realize is that valuation is not just a function of, you know, the success and the progress of the company usually, and we're talking about, you know, at the early stage, so, you know, friends and family through Series C, but it also is somewhat of a function of the round size. So as companies grow, it gives them the ability to raise larger and larger amounts of capital in a sane market. And we know that, you know, the last few years, things got a little insane, but I would say that this chart is going to kind of give you an idea of what a company with a very healthy capital strategy might raise with. And I'd say that this set of guidelines reminds me very much of one of our portfolio companies that we started investing in 2015. It was actually one of our first deals on 1,000 Angels, and the company, you know, has just raised I think a Series E at about $1 billion valuation, but they started off really slow and sane, which was amazing, right? So for most companies, you're going to see pre-seed rounds getting done of somewhere between $250K and $1 million. And for those rounds, you kind of expect valuations to be somewhere between 3 and 5 million, depending on, the stage and progress of the company. But these would basically be pre-revenue companies that are taking in their first slug of capital. And that capital might come from friends and family, from accelerators, from angels, from Republic. But these are companies that are, pretty early and don't necessarily have a ton of valuation. By the time you get to a seed round, which is usually 1 to 3 million, where you're going to have a lot more success going to sort of external professional investors, and those could be micro VCs, seed VCs, scout funds, et cetera, you're going to be raising in chunks of usually over $1 million. So somewhere between 1 and 3 million would be a seed round. And for that size of round, appropriate valuations are somewhere between 4 and 12. But the important rule of thumb is that in any particular round, your company's progress and pre-money valuation needs to be able to support you not selling more than 20% to, I would say, about 33% of the company. So remember, round size is a bit of a function of the valuation. You don't necessarily want to sell more than sort of a third to a fifth of the company in any one round. As we get to Series A, which is usually now considered kind of like 3 million and up, we see valuations in the sort of $10 to $30 million range. And then for Series B, which is usually 10 million and up size round, you see valuations of 25 to 100 million. And Series C, you're probably not participating in that, but that's more growth equity rounds. You're looking at $75 million plus valuations. So the important thing about this chart to recognize is that as investors, we are looking for our investments to be able to create this sort of value evolution. That means that when I invest in a seed round of, let's give the average one, a $2 million seed round at a $8 million pre-money valuation, I'm hoping that the company is going to be able to take that $2 million and do whatever it needs to do to maybe be able to get to a $5 million Series A at a $25 million valuation, right? So I'm really thinking, can this company, on the amount of capital that I've invested and the valuation that I've assigned to it right now, sort of get to that next valuation milestone with the money they have? And if you don't think that they can, it might mean that you've overvalued the company a little bit. So we always want to think of it as value evolution and as progression to getting the company eventually to a point where it can be acquired. And one of the most important things to realize about a company being acquired or having some other sort of liquidation event is that generally the total market capitalization of the company has to be usually at least 100 million, closer to probably $200 million or so in order for it to be attractive as an acquisition candidate. So we need to say to ourselves, based on where the company is now and the amount of money that they need to continue raising to get to that 200-ish million in valuation, can I see them getting there on this capital? And this is sort of how we back into valuation. So think of it as like little baby steps from where you are now to hopefully exit, which is a couple $100 million. And as you can see on the bottom line, when you guys go back to it, you can see sort of approximate revenue milestones that go along with these different valuation and round sizes. All right, we can go to the next slide. So this is like a really simple chart that just sort of shows you guys a little bit of the factors that either sort of make a company a little bit more highly valued or make it a little bit more attractive. So the way that we would say here is sort of on a risk-adjusted return basis, is a deal cheap? That would be anything that's kind of like below the line. Or is it a little bit more expensive? That would be anything that's above the line in sort of, the upper quadrants here. So we can see some of the factors, as you're looking at, this sort of asset class where valuations ring in somewhere between as low as a $3 million pre-money valuation for a very early company to up to kind of like a $15 million pre-money valuation, which would be sort of like a typical Series A valuation. what factors are going to drive the changes in those valuations. So there are some really simple traction ones, like, do you have an idea? Great, that's the basic. You know, is there a mock-up? Do you have a minimum viable product? You know, have you now had pilots? Have you achieved product market fit? Are you ready for actually showing growth, right? So those are the things that are kind of, you know, the very, you know, more objective types of issues that you can value a company on. But then we have these other little things that are kind of, you know, scattered around the plot that are going to drive you either towards being a little bit more expensive as a deal or being a little cheaper. And just as Cheryl said at the very beginning, you know, you'll definitely find better value in companies that are sometimes not from the Bay Area, not from LA, not from New York City. You know, we've seen some of our best investments come out of places like Cincinnati and Detroit, and, you know, sort of those cities that might be a little bit overlooked and where there's less access to capital, so you can get, you know, cheap deals. Another thing is underrepresented founders. You know, we've historically seen minority-led and female-led companies come out raising money, you know, at valuations that are not as high as you know, some other people can raise money at. And so as an investor, that's actually an opportunity for you to generate alpha and realize value, you know, if you're actually in those deals, because once they kind of get out of this, you know, sort of early stage, you know, there are less discounts on the equity, right? They're still going to be acquired for the same at the end, and you will have a higher return. And then of course, consumer products companies tend to trade at lower multiples than, you know, a software SaaS tech company with no assets would trade. Some of the things that, you know, end up driving up valuation is of course, previously successful founders. You know, if, I don't know, Elon Musk came out and said he was doing a startup, you know, he's not going to be raising money at a $3 million valuation. That's like an extreme example, but you get the idea. So if somebody comes to you and says, listen, you know, I started 2 companies before, I sold them, you know, each for $250 million, they're going to be able to command a bit of higher valuation than a first-time founder. You know, companies in the Bay Area, just because of supply demand factors, you know, companies coming out of YC, it's like, you know, the Harvard of coming out of an accelerator. And then of course, you know, if you actually have valuable intellectual property, you'll also be able to raise at a higher than average valuation for your traction. All right, great, next. And so, you know, here, this is just a chart for you guys to go back and refer to later. I won't go through the whole thing, but just to show you sort of some valuation milestones in terms of where you might be in revenue and also in monthly recurring revenue in order to actually realize certain valuation numbers. So, you know, you'll sort of be in friends and family land until you're a bit over at least 1,000 in monthly recurring revenue. I would say once you get to at least 10K in monthly recurring revenue, you can start thinking about doing a pre-seed or a seed round. Series A usually happens around 100,000 in monthly recurring revenue. And then Series B plus at sort of like the milestones are getting to 250 and then getting to 1 million. So the important thing to remember is that there's such a huge difference between a company that can generate 1,000 in monthly recurring revenue and 10,000. And then to break out to 100,000 is actually really, really hard. Some people can get to 100,000, but then to break to the 250 is another inflection point. So these inflection points are indicative of the scalability of your business and the total amount of risk from an investor standpoint. And I note some of the things that companies usually need to achieve when they get to those particular points in the bullet points. And then also, you know, the valuations that might go with it. And of course, you know, this is also dependent on those other more subjective factors. So I think this is our last slide. Do we have another one, Cheryl? I know you deleted a bunch of my slides. Oh, right. Okay. So some of the basic drivers of value, just to go through, you know, number one is a really strong management team. And this is why, you know, people will find as solo founders, they often have a much more difficult time raising money. So even if you don't have a co-founder, just having actually aggregated a great management team will add tremendous value to your business, because recruiting great people is actually one of the hardest things to do with a startup. So look for a great management management team. Of course, the size of the addressable market. You know, if the addressable market is 100 billion, the company is going to be worth more than if the addressable market is $1 billion. Actually having achieved product market fit, you know, we could talk about product market fit for several hours, so we'll have to skip that today. And then also like really understanding your customer acquisition channels and the scalability of those channels. And then I say the other things, you know, of course, competitive advantages, intellectual property, barriers to entry, your traction and growth potential, and then don't forget about exit opportunities. You need to figure out, are there people with money who can potentially buy this company at some point in the future? If not, you know, do you realistically expect them to go public? It's less likely, it's more of an edge case. So we want to think about all those ways around how do we get liquidity at the end of the day. Next slide. Okay, great. And so as far as for a seed round, the possible valuation methods that people use, and I'll just go through a few of them, but we'll talk about the main one, I think, on the last slide, is benchmarks, and that's just sort of using recent valuation metrics for similar companies. In order to properly benchmark, you kind of need to be in the market, because just as an average Joe, you're probably not going to know where other deals got done or where they trade. So, you know, if you have friends that work in venture capital, if you can, you know, do some research and get this information, it's not publicly available usually, but you can do some comparative research. And I think it's really important to, you know, get information around where deals actually got done, not just like what somebody said they wanted to raise at, because you'll see people go into the markets like, oh, I'm raising at a, you know, $20 million valuation. And you can say that all day, but unless you actually like raise the money at that valuation, it's not a valid data point. The next is the Burkus method. Anyone who's interested in Googling that can go look it up online. It's kind of interesting. And then the last one that you'll probably hear about a lot is deferred valuation. And that would be using a SAFE, which is a simple agreement for future equity, or a convertible note to kind of defer the valuation until the company has a bit more traction and can actually do a priced round. So typically you'll defer the valuation, but you'll put some sort of a cap or an upper limit into the documentation to know, well, we'll see what the price ends up being, but it's not going to be more than, you know, $8 million or whatever your cap is set at. Great. And do we have another slide? Okay, great. So I think this is the last one. So the one that we actually use for most of our deals is pretty simple. It's the venture capital method. And I guess if you're somebody who's like really familiar with math, this can be really simple, but essentially we want to think about, you know, where can this company be in valuation, let's say in the next 5 years, right? So when you're making an investment, you're going to look at a company's financial model. You're going to say, okay, you know, at year 5, they're expecting to do 100 million in annual revenue. I expect this company to trade at 5 times revenue. So the company will be worth 500 million at the end of, you know, 5 years. So given that, what you kind of want to think is, all right, if I need, you know, to get a 10x return on my investment, you know, right now, will I actually receive a 10 to 20x return on my investment if they sell for, you know, this $500 million in 5 years based on the current post-money valuation? So that would mean that, you know, assuming the company had no more capital raises, which, you know, doesn't usually happen, but just back of the envelope, that the current round couldn't be priced, you know, at more than 25 million post-money, right? To sort of get you to that 20x. So that's kind of the way that we want to sort of back into the viability of the investment, is that, you know, if my return objective is 20x, if it's 10x, what does the company need to sell for in 5 years in order for me to actually achieve that return? And that helps you just sort of understand, is the current valuation kind of in the right ballpark for me to achieve the IRR I need to sustain a great performing portfolio? So I think that's the end of my slides. I had like 30.
No, exactly. I think you had a fantastic amount to say, and I think we got so many questions. I will just ask one before we go to the next one. So I think one of the most upvoted ones was like, how long have you been doing this? Can you tell us about your most successful exit? your hardest, most expensive lesson learned. I will say there was another one that said, when will the recording be available? And just for everyone here, we will be posting it in our YouTube parts of it. And we'll make sure to send that out in our follow-up email. So Erica, what is,
Yeah, absolutely. So, we definitely, so I've actually been doing this, I think I mentioned at the beginning. So I've been doing this sort of investment for about 14 years. I would say that our, highest cash on cash multiple return exit was about 70x, which is great. So, the downside is that these things do take a really, really long time to mature generally, but it's also wildly unpredictable. So sometimes you'll invest in a company and, they'll get acquired early and you'll only get 2x, but it was like a year later, right? Sometimes it's going to take 10 years. But, at the end of the day, we do need to require like pretty high return multiples across the board in order to compensate the portfolio for the fact that there are going to be a good percentage of things that, might go to zero. I mean, that's entirely possible. But also things that kind of just break even or don't really get anywhere for a really long time. So, you might see businesses that are able to, keep sustaining themselves and keep growing, but won't necessarily provide a huge multiple exit within a reasonable time frame. And it's really that time value of money that requires these exit numbers to be a little bit larger than you might think that they would be. So the other thing I wanted to mention too is that, I know that we're supposed to sort of put our contact information in the chat and everything. I do have loads and loads of like in-depth webinars that you guys can access if you sign up for our newsletter. So on 1000angels.com, if you sign up for the newsletter, you'll get access to our investor training library. And we sort of go into these topics really in detail. We also have a YouTube channel that has plenty of information where I get into like the nitty gritty on everything. So if anybody's really wants to nerd out, they can find more info there.